You know, the market has a funny way of teaching you what no man can explain in words. You can read every book, follow every guru, run through every indicator, and still the market will expose every belief you hold that isn't aligned with reality. It doesn't humble you because it's cruel. It humbles you because it forces you to confront the truth about uncertainty, probability, and your own mental biases. But once you begin to accept the market's randomness, once you learn to wait for the conditions that genuinely reflect your edge, instead of reacting to every emotional impulse, that's when the fog begins to lift. Today, I want to talk about something directly connected to that: a high win rate strategy. And if you remember the previous video on cutting losses and letting profits run, this is the natural psychological continuation. Because once you understand how to defend your capital, the next step is understanding how to grow it through consistent execution, calmly, methodically, and free from emotional distortion. People always come to me asking, "What's your winning strategy? How do you choose trades that actually work?" And the truth is, there is no divine formula, no perfect prediction model. The market doesn't reward intelligence. It rewards traders who can think in probabilities and act without hesitation when their edge appears. A high win rate strategy doesn't mean winning every trade. It means you've trained yourself to recognize the conditions where your edge has the highest probability of playing out. Over time, that makes the outcome statistically inevitable. Ask yourself, do you need to win every trade to be consistently profitable? Of course not. You simply need to lose small when you're wrong and let the market pay you fully when you're right. That is the essence of consistency. Now, when I talk about achieving a high win rate, I don't mean chasing these fantasy claims of 90% accuracy floating around the internet. Forget that entirely. I'm talking about a repeatable setup, a mental model you understand so thoroughly that you recognize it forming long before the average trader even notices something is happening. It could be a breakout proving strength above resistance or a pullback stabilizing at volume support. But whatever it is, you've tested it, internalized it, and built confidence in it. Because if you don't genuinely trust your setup, your mind will sabotage you at the exact moment you're supposed to act. And when doubt steps in, execution breaks down. Think about times you've seen the perfect setup unfolding and still hesitated. Maybe you told yourself, "Let me wait for one more confirmation." But by the time you acted, the market had already moved without you, leaving you either watching the opportunity disappear or chasing it late and getting punished for it. I've been there myself more times than I'd like to admit. The lesson is simple. A high win rate approach isn't about guessing right. It's about preparing your mind correctly. You don't win in the heat of execution. You win through the mental framework you build long before you enter. That's what most traders never understand. Every reliable trading setup is built around three elements: timing, price, and volume. Miss one, and your probability drops. When all three line up, the edge becomes powerful. But here's the thing. Your job is not to predict when that alignment will appear. Your job is to perceive it clearly and act with total confidence when it does. The market rewards traders who are mentally aligned, and it punishes hesitation rooted in fear. So ask yourself, how clear is your trading plan, really? Can you define your edge without looking at a chart? If not, you're not trading, you're gambling. Many traders confuse movement with progress. They think more trades equal more chances to win. But that's emotional compulsion disguised as work. A high win rate strategy is built on selective participation. You wait for the A-grade setup. You ignore the B and C trades no matter how bored you feel. One of the greatest truths in trading is that money is made by waiting, not by acting. Sitting and watching requires more discipline than clicking buttons. But that patience is exactly what separates consistent performers from emotionally driven hopefuls. Now let's shift into psychology for a moment. You can have the sharpest system in the world, but if your mindset isn't aligned with the principles of probability, you will sabotage the system every time. Fear makes you cut winners too soon. Greed makes you ignore warning signs. Hope makes you hold losers longer than your rules allow. Discipline, true consistency of mind, is the bridge between strategy and results. You cannot sustain a high win rate without emotional neutrality. The two are inseparable. Ever notice how the best trades often feel uncomfortable at first? That's because they require trusting your edge, not your emotions. And tying this back to what we discussed earlier, cutting losses and letting profits run, the ideas fit perfectly together. When you eliminate big losses and allow your winners to expand naturally, your system becomes higher in win quality, even if your win rate itself isn't extreme. That's one of the great paradoxes of successful trading. You don't need to win often, but you must behave as if every trade matters in terms of discipline. A high win rate isn't a percentage. It's your ability to execute your rules consistently. Most traders spend their careers hunting new indicators, new teachers, new magic shortcuts. Professionals spend their time refining the beliefs and processes that already work. They study their execution, their performance, their behavior, until they intuitively feel the market shifts the same way a seasoned observer feels a change in the wind. Ask yourself honestly, when was the last time you analyzed your own trades with the same intensity you use to study someone else's strategy? The answers are usually hidden in your own performance data, not in another person's technique. The beauty of a truly reliable system is that it builds confidence, real confidence, not ego. Every winning streak should make you more grounded, not more arrogant. Because the moment you start believing you're unbeatable, the market will correct that illusion instantly. I've seen too many traders lose fortunes because they mistook luck for skill. True consistency proves itself across dozens, then hundreds of trades. Through volatility, through chop, through uncertainty. A high win rate reflects your habits, not your hopes. Look at your results carefully. They're always telling you something about yourself. Remember, the market reflects information. It speaks through price. It tells you everything you need to know if you're willing to listen without projecting your fears or expectations onto it. When the market reveals its intention, your job is to respond, not argue. That's how you survive the difficult stretches and capitalize on the periods of clarity. When your discipline and the market's opportunity align, the entire game transforms. The market becomes your partner, not your adversary. But to reach that level, you must train your perception to see what others overlook and train your mind to wait for what others impulsively chase. I've always said the market doesn't change. Only the faces and technology do. Fear, greed, and impatience are the same psychological forces now as they were a century ago. That's why a high win rate strategy is never just about the market. It's about mastering your internal environment. So before your next trade, ask yourself, am I entering because the setup fits my rules, or because the opportunity is tempting my emotions? The answer separates fleeting luck from long-term consistency. A high win rate strategy is never built on random impulses or emotionally charged decisions. It emerges from alignment, alignment between your beliefs, your rules, and the market's behavior. And when I say alignment, I'm talking about the harmony of three core elements that shape every successful trade: timing, price, and volume. Miss one and you're out of sync with the rhythm of the market. Get all three right, and you're trading in tune with the market's flow. That's when the probabilities quietly shift in your favor. And that's when the market begins rewarding your patience, clarity, and discipline. Let's begin with timing. Timing is the heartbeat of the entire market. You can have the most reliable setup in the world, but if your entry is too early or too late, you end up fighting the market rather than moving with it. Traders often think in terms of catching a move, but every move unfolds in a sequence. A build-up, then a release. Your job isn't to predict when that release will occur. Your job is to recognize the moment the market reveals it. Ask yourself how often you enter a trade because you think it's time instead of waiting for the market to prove it's time. That single difference separates impulsive trading from professional-grade confirmation. Most traders crave action, but the market rewards patience. True timing comes from observation, not anticipation. You watch the movement, you sense the shifts, you let the structure reveal itself. It's like watching the tide. You don't command it. You observe it until it turns. When you learn to wait for the market to show its hand, your entries stop feeling like guesses and start feeling like intuitive, measured responses. That's what real professional trading is, a series of calm, disciplined responses to opportunity. Then comes price, the simplest, yet most misunderstood component. Price is the purest reflection of collective belief. It represents what the market accepts as value right now, not what you think it should be. Every tick is the result of someone buying and someone selling, shaped by the psychological tug-of-war between fear and desire. Traders get into trouble the moment they argue with price. They buy because something looks cheap, or sell because it feels expensive. But the market doesn't care what you think is cheap or expensive. The only truth is the movement of price itself. When price breaks above resistance with conviction, that's the market expressing a shift in collective belief. When it fails to hold support, that's the market revealing weakening commitment. Learn to read these signals as information, not as puzzles or predictions. The most consistent traders I've ever known didn't predict where price would go. They responded when the market made its intention statistically clear. And here's the important part. Price doesn't move without context. It rotates through cycles of accumulation and distribution. When you align yourself with those cycles, you stop trying to impose expectations on the market and instead flow with the probabilities it offers. Now, volume. This is the hidden psychological force behind every move. If price is the story the market is telling, volume is the emotional conviction backing that story. Volume determines whether the narrative the market presents is trustworthy or uncertain. When price breaks out but volume is weak, that's a whisper of participation. When price surges with strong volume, that's confidence speaking loudly. Volume shows you whether the major participants, the ones capable of sustaining trends, are stepping in or stepping aside. And here's a truth many ignore. No meaningful trend begins without volume setting the foundation. Too many traders look at charts like they're static images. But charts are dynamic reflections of beliefs, fears, and decisions. Volume is the pulse that exposes how alive or fragile a move really is. If price climbs while volume fades, it reveals diminishing commitment. If you see a pullback forming on lighter volume, it's often nothing more than the market pausing before continuation. Understanding that difference keeps you out of traps and prevents premature exits. Now consider this. Timing, price, and volume are not separate elements. They form a feedback loop. Volume validates price. price reveals direction. Timing determines the precision of both. When these three combine, you shift from guessing to reading the market with clarity. Every powerful trade setup is like a well-tuned chord. Each component must be harmonious. If timing is early or late, even the most attractive price levels can betray you. If volume doesn't confirm, even flawless timing becomes unreliable. And this is where discipline becomes indispensable. The temptation to take trades without alignment is constant. The chart flickers, your emotions flare, and suddenly you rationalize, this one looks good enough. But good enough is the mindset that destroys consistency. Professionals don't settle for almost right. They wait for synchronized conditions, for that perfect balance where timing, price, and volume align like stars before sunrise. It won't appear every day, but when it does, you'll feel it with a sense of calm certainty. The tape will speak without ambiguity. Hesitation disappears. It takes years of observation to see these alignments clearly. You begin recognizing when volume is leading the price, when price is attempting to deceive, when timing is premature. The patterns repeat, but your mind must be trained to perceive them without bias. You start noticing how strong trends always begin with subtle accumulation, volume rising quietly while price consolidates. Then one day, timing clicks. The expansion begins, the crowd realizes what's happening, and the move unfolds exactly as it should. That's not luck. That's alignment meeting preparation. So when traders ask me, what's your secret to a high win rate? I tell them, it's not about more trades, it's about the right ones. The right trade feels almost effortless because you're aligning with the market's energy, not fighting against it. You're not forcing the outcome. You're flowing with it. That's the natural result of timing, price, and volume coming together as one. You stop trying to impose your will and instead cooperate with the market's structure. Think of it this way. If price moves up but volume doesn't support it, what is the market really telling you? It's saying the enthusiasm is thin. If volume spikes, yet price refuses to progress, that's conflict. Buyers and sellers battling for control. Timing becomes your compass, guiding you to when that conflict resolves. When all three elements align, your trades shift from uncertain gambles to evidence-backed probabilities. And that is the foundation of a high win rate approach, clarity through alignment. Most traders obsess over entries and exits, but the real power lies in understanding the narrative the market is telling through its timing, its price movement, and its volume behavior. When you can read that narrative fluently, you stop being a spectator and become a direct participant in the unfolding story. Cutting losses quickly increases the quality of your wins. That's not just a guideline, it's a fundamental law of survival. Every experienced trader who's lasted understands this law instinctively. Success isn't defined by how many trades you win, but by how effectively you manage the ones you lose. The moment you learn to close a losing trade without hesitation, you separate yourself from the masses who cling to hope instead of reality. Hope isn't a strategy. The market doesn't reward emotional attachment. It rewards disciplined action. You can't control whether a trade becomes a winner or loser, but you can always control the size of that loss. That's where genuine power resides, in your ability to limit damage. Ask yourself, how many times have you watched a small, manageable loss grow into something destructive because you couldn't accept being wrong? How many times have you told yourself, I'll just give it a little more room, only to watch that little room become a costly mistake? Those moments define your identity as a trader. Everyone remembers the first major loss they refused to cut. It brands itself into memory like a scar. But that scar isn't a failure. It's a lesson. It's the tuition you pay to align your beliefs with market reality. The faster you accept that losses are simply business expenses, the quicker you evolve into a true professional. A professional doesn't panic at a loss. He observes it, records it, learns from it, and moves forward with undisturbed focus, because he understands that small losses preserve the capital and clarity necessary for the next high-probability setup. Here's a truth that takes years to internalize. Cutting losses early isn't just about protecting money, it's about protecting your mind. A large loss damages far more than your account balance. It distorts your judgment. It generates hesitation. It fuels revenge trading. But a small, disciplined loss keeps your mental state clean. You remain in sync with the market's rhythm. You don't lose perspective. You move to the next opportunity without emotional residue. That is how consistency is built. Now let's connect this to how it elevates the quality of your wins. When your losses are small, your winners don't need to be extraordinary to grow your account. A trader who risks 1 unit to make 3 can be wrong often and still emerge profitable. That's the beauty of disciplined risk control. It magnifies the impact of your winners. You're no longer relying on big wins to patch up big mistakes. You're building steadily, trade by trade, with precision. Cutting losses quickly gives every winner more power because it's not weighed down by past errors. Think of it like pruning a tree. You remove weak branches early so the healthy ones can flourish. Trading works exactly the same. A quick, small loss is a pruning cut. It keeps your capital resilient, your confidence stable, and your performance consistent. The trader who refuses to prune eventually watches entire branches collapse under the weight of bad decisions. Wealth can't grow under that burden. Growth requires discipline and the understanding that not every trade deserves to survive. Cutting losses fast also reinforces trust in your own process. When you see yourself executing your rules without emotional interference, you begin respecting your own discipline. That respect transforms into confidence, and confidence is the oxygen of trading. Without it, you suffocate under hesitation and self-doubt. The more you trust your system, the easier it becomes to let winners expand naturally. There's a direct connection between your ability to accept a loss and your ability to let profits grow. Most traders never see this. They treat the two as separate, when they're inseparable halves of one mindset. Remember how in the previous discussion about cutting losses and letting profits run, we talked about freeing your capital to flow where it's most productive? That principle applies here as well. By removing losing trades quickly, you free not only your capital, but your mental focus. You're no longer chained emotionally to dead positions. You can shift your attention to opportunities that genuinely align with your edge. That's how compounding truly begins, not just financially, but psychologically. Each disciplined decision strengthens the next. The market punishes hesitation. When a trade moves against you and you freeze, it's rarely because you lack knowledge. It's because your ego resists being wrong. But being wrong is part of the probabilistic nature of trading. The most successful traders aren't right often. They simply refuse to stay wrong for long. That's the shift. When you view a stopped-out trade not as a failure, but as the cost of maintaining clarity, your entire relationship with the market evolves. You stop resisting the market's message and begin aligning with it. The tape reveals truth every second. Your role is to accept and respond, not argue. Let's be clear. Cutting losses quickly doesn't mean reacting emotionally. It means acting mechanically according to your rules. You don't exit because fear spikes. You exit because your predefined risk boundary has been hit. That's the difference between fear and discipline. Fear reacts. Discipline executes. Your stop loss isn't weakness. It's protection. It's the boundary that saves you when the market shifts. And here's something most traders don't realize. Small, frequent losses are signs of a healthy, disciplined trading process. They show you're taking structured risks and keeping yourself positioned for the trades that matter, the ones with real potential. The same lesson reveals itself over and over. The fewer deep cuts you allow, the more resilient you stay for the opportunities ahead. Cutting losses quickly also changes your relationship with the market. You stop seeing the market as an enemy trying to take your money and start seeing it as a partner offering continuous feedback. Each stopped-out trade becomes information, pure, objective data. It tells you something about timing, about volatility, about the collective psychology behind the move. When you stop taking losses personally, you begin using them professionally. Every disciplined exit becomes a clue, a note in your trading journal, a piece of evidence that sharpens your probabilistic edge. So ask yourself the next time you're staring at a losing position, what's actually stopping you from closing it? Pride, hope, or the fear of being wrong? Not one of those emotions has ever added a cent to a trader's account. The only thing that pays is execution grounded in rules. Cut fast, cut clean, and you'll notice your winners begin to stand out more clearly. Not because they suddenly grow, but because your discipline has amplified their meaning. Every trade you take should have purpose behind it. Not impulse, not boredom, not the desire for stimulation, purpose. There is an enormous difference between entering a trade because it aligns with your edge and entering simply because the market is open. Most traders never learn that distinction, which is why they remain mediocre. The market presents movement every day, but movement is not opportunity. The traders who endure, who progress, who genuinely build wealth, learn to wait for setups that meet their criteria entirely, not halfway. They understand that patience is the invisible power of a professional trader. When you enter a trade because it is right, it means you have seen confirmation. It means the market is expressing strength or weakness consistent with your plan. It means your risk is defined, your timing is aligned, and your conviction is rooted in evidence. Entering simply because the setup exists is what amateurs do when they can't handle being out of the market. They see motion, and motion seduces them. But the market does not pay for motion. It pays for precision. Ask yourself, how many of your losing trades were born out of boredom rather than strategy? How many were taken just to feel active instead of being correct? I've watched traders who could interpret charts with incredible clarity, yet they still couldn't resist taking random positions when the market was quiet. They would fire trades into uncertainty, hoping something might happen. It's like a hunter shooting into the dark, praying to hit something he can't see. A professional would never do that. A professional waits until the target is visible, the conditions are clear, and the probabilities are aligned. Trading is no different. Every position you take is a shot fired. You cannot afford to waste ammunition. The reality is that most of trading is waiting. It's observing patterns form, waiting for confirmation, and doing absolutely nothing until your criteria align. That part of the process is not glamorous, which is exactly why so few traders master it. But that is where your edge is created. You must accept that the market doesn't reward activity. It rewards accuracy. When you enter because the setup is right, You are aligning with probability. When you enter because the setup merely exists, you are acting on emotion. One is grounded in skill, the other is driven by impulse. You can identify a disciplined trader simply by reviewing their trade history. Their entries are sparse, intentional, and precise. Their charts are clean, uncluttered by noise. They aren't chasing setups every few minutes. They are hunting one thing, a focused, high-probability opportunity where timing, price, and volume narrate the same story. Everything else is dismissed. Reaching that level requires maturity because it demands releasing the illusion of control. You cannot make the market move. You can only align with it when it chooses to move. Early in my trading life, I believed being constantly present in the market meant I was productive. But the tape eventually taught me the truth. Sometimes the best trade is no trade at all. Waiting is not weakness. It is strength exercised with restraint. It is the sign of someone who understands that trading is not about constant engagement. It is about strategic precision. You don't make money by forcing trades. You make money by recognizing the right ones and executing them flawlessly. The struggle, however, is psychological. The market pulls at your attention with every flicker. The candles move and immediately your mind whispers, "You're missing opportunities." That is the precise moment discipline is tested. You must remind yourself that your goal is not to trade more. It is to trade better. You cannot treat every setup as an opportunity. Most are traps disguised as possibilities. Consider how many times you jumped into a trade because you feared missing out, only to discover moments later that the move was already finished. The market rewards patience with surprising consistency and punishes impatience with even greater consistency. When you only enter trades that are right, you create a clean, emotional space around your decisions. Each trade becomes an intentional commitment rather than a reaction to noise. You're no longer driven by the need to participate. You're driven by the need to protect your edge. And when you protect your edge, you protect your capital. A trader who waits for confirmation before acting may lose occasionally, but those losses are small. The trader who acts impulsively risks losing everything. The beauty of selective trading is that it preserves your confidence and your account simultaneously. Now, reflect on what we discussed about cutting losses and letting profits run. This philosophy connects directly. The fewer random trades you take, the easier it becomes to manage your positions effectively. When you enter only because the setup is right, your trades have structure, logic, and discipline supporting them. You know exactly when to cut your loss and when to let your profit breathe. That is the fundamental difference between a professional's mindset and a gambler's instinct. A gambler trades to feel alive. A trader trades to endure and prosper. The market filters out those who cannot control themselves. You can possess exceptional analytical skill, but if you act impulsively, the market will strip your gains faster than any miscalculated chart analysis. Self-control is your strongest defense. It is not enough to know what to do. You must have the discipline to do nothing until the moment is right. That is the separation between a good setup and a genuinely profitable trade. Every forced trade dulls your instincts. You train your mind to believe impatience is acceptable. But every time you wait for the right setup, you sharpen your intuition. You reinforce discipline. The market begins to reveal itself differently. Patterns become clearer. Price action makes more sense. You stop guessing and start interpreting. The market rewards that kind of clarity with consistency. There is another advantage to taking trades only when they are right. You trade with conviction. You don't second-guess yourself mid-trade because you know you entered according to your plan. That conviction anchors you through volatility. You're not shaken by every minor fluctuation because your decision wasn't emotional. It was structured, purposeful, intentional. And when you trade with intent, you naturally manage your positions better. You take profits when the market offers them. You cut losses when your signal invalidates. You avoid emotional interference. Ask yourself, what kind of trader do you want to become? The kind who reacts to every flicker of movement? Or the kind who waits for the moments that actually matter? The answer determines not only your win rate, but your longevity in the game. Because the truth is this: trading isn't about constant activity. It's about selective accuracy. Every truly great trader I've known learned this lesson through experience. The market doesn't care how often you trade. It cares how well you trade when you choose to act. So the next time you feel the urge to take a position, pause and ask yourself, am I doing this because the setup is right or simply because it exists? The distance between those two answers is the distance between speculation and mastery.